The last time we made a video about Genworth Financial, the company was about to have an IPO for its US mortgage insurance business. Since that video, the proceedings for the IPO are still ongoing. We don't know yet when it will happen, but things are looking good for the IPO. And since that video, the company bought back some of its debt. This is a good news for us and makes us think that maybe in the future, which is a possibility that Genworth Financial is considering, they can return money not just to bondholders but also to shareholders by buying back shares or paying dividends. So these are possibilities for Genworth Financial now. They are reducing their debt and possibly in the future they can use all the cash they have to pay dividends and buy back shares. There were, however, some bad news about Genworth Financial. The housing boom that has been happening is now decelerating. People are buying less houses now. Of course, compared to past years, it's still big, but compared to what it was in the beginning of this year, there is a deceleration. So, should we be worried about the future of Genworth Financial? I don't think so. I think the future of Genworth Financial, the stock, is still here. It is a potential Tenbagger, even though the stock already gained 50% since the beginning of this year. So in today's video, we are going to talk about Genworth Financial. Why do I say it is a potential Tenbagger? We are going to have a look at the housing market and we are going to talk about the IPO of Enact and what it means for Genworth Financial as a long-term investment. Before we talk about all of this, please make sure to smash the like button for the YouTube algorithm. If you are new to the channel, my name is Ishfaaq. I am an elite popular investor on eToro with over $2 million in assets under management. So please subscribe and hit the notification bell so that you don't miss the coming videos. I say that Genworth Financial is a potential Tenbagger. I believe it is very important to say what I mean by this, to tell you what I mean by potential Tenbagger, because I have seen some comments on eToro when I said that UNFI is a potential Tenbagger and the stock crashed by 15% on a day. Some people will say, what's happening to the Tenbagger? It's crashing. I said to use a potential Tenbagger, the stock price is crashing by 50%. When I say something is a potential Tenbagger, the meaning of a Tenbagger is that it can gain at least 900%, that is 10 times in its initial value in 10 years or less. So if I say Genworth Financial is a potential Tenbagger, maybe it can gain 900%. That is, if today you invest $200, it can go to $2,000, maybe next year, maybe next month, or maybe even in 8 years. This is a Tenbagger. I had only one Tenbagger since I've been investing, GameStop. Actually, it was a 100-bagger. Even though I invested in GameStop for 17 months, so it took me 17 months for the Tenbagger to happen. At some point, I was down 60% on GameStop. So when I'm saying that something is a Tenbagger, it doesn't mean it will happen like GameStop in 17 months. It can take 7 years also. So you need to be careful with that. Always think about the long term. Those stocks which are potential Tenbaggers are always going to be volatile. So make sure you understand the risk you're taking. If you cannot handle this volatility, you can always invest in other things, in bonds, in treasury bonds. You will have less volatilities there. Now let's talk about why Genworth Financial is a potential Tenbagger. I have already talked about this, why Genworth Financial is undervalued. This is the deep value stock. Genworth Financial has 3 main business segments. Last year they had 3, now it's only 2. Soon it's going to be only 1. So the 3 business segments they had were the Australian mortgage insurance business, which they already sold, the US mortgage insurance business, this is where they will have the IPO, and finally, life insurance business. So they want to keep the life insurance business and have an IPO for the US mortgage insurance business. So this IPO, they are going to call it Enact. The new company will be called Enact. And Genworth Financial, after the IPO, is still going to own at least 80% of Enact. So it's going to be only a partial IPO. It's not like what eBay did with PayPal. They just had a spin-off of the whole company. For Enact will still be owned at 80% at least by Genworth Financial. Why do I say at least? Because of underwriters, they won't need to buy so much, and also there's a hedge fund involved. Maybe it can go from 80 to 85%, but at least 80%. So 80% of all the assets of Enact will be on the balance sheet of Genworth Financial. 80% of the revenues of Enact will be accounted on the income statement of Genworth Financial. From this social IPO, Genworth Financial is going to gain at least $500 million US. This is the amount of money they want to raise from the IPO of Enact, which will give Enact its valuation of about $4.85 billion US. And I believe that the market cap, the valuation of Enact eventually after the IPO can go up. Because there are so many tailwinds on mortgage insurance right now. We have record low mortgage rates. People are taking more and more mortgages to buy houses. You may say that there has been a deceleration. It's true. The main reason why we have a deceleration today is because there are not enough houses available for sale. Everybody is buying houses. That's why we have this deceleration. But if you look at how people are taking mortgages, refinancing is actually bigger than to buy new houses. So people are still going to refinance. People want to build better houses right now because of inflation. Inflation always drives prices of homes up because real estate is a hard asset. So people want to buy houses in order for them to protect themselves against inflation. So I believe that even though the housing boom is decelerating, we can still expect a long-term housing boom to continue. In the short term, yes, we may have this volatility, it may decelerate, but if you are thinking about the long term, maybe it won't grow like in 2007. We don't want it to happen like this in 2006, 2007 when we had the crash. But still, we can expect a housing boom to continue. It won't be the same boom, but an acceleration, a growth in the housing market and consequently in mortgage insurance. So record low mortgage rates, inflation, all these are good for Genworth Financial. Now you may say if inflation is good for Genworth Financial, what happens if the Fed raises interest rates? If we have inflation, the Fed will raise interest rates. Yes, it will be bad for Genworth Financial if you look at the mortgage business. Because when we look at the mortgage business, interest rates rises, mortgage rates will rise, people will take less mortgages. But because Genworth Financial is an insurance business, they are constantly buying bonds. The yield on the new bonds they are going to buy, because once they are constantly buying bonds. So let's say they already own bonds here, they mature, they make money, they buy new bonds. So when they buy these new bonds, the yield are then going to be higher. So they are going to make more money from the yield. They are already having more interest cash flow compared to market capitalization. We are going to talk about that in a few minutes, how undervalued Genworth Financial is today. Let's go back to Enact. So Enact, there's so many tailwinds on mortgage insurance. That's why I have another mortgage insurance business in my portfolio, Ascent Group. And if we are going to value Enact as we value Ascent Group or even all the other ones, then it seems that Enact at $4.85 billion US is undervalued. If really we have so many tailwinds on this industry, in the future, the valuation, the price to tangible book value ratio on Enact is going to increase. So the valuations on Enact are going to increase and consequently, this will be reflected on the balance sheet of Genworth Financial. And we can expect that the valuations on Genworth Financial are going to increase too. Normally, this is what happens. Maybe the market will be like they are doing today. They won't like Genworth Financial. But normally, the market eventually, they realize their mistake and they overdo it. They always overdo it. When they are making a mistake and then they see their mistake, they try to correct it, there is always an overcorrection. Like with GameStop, there was an overcorrection. It was undervalued, it was a deep value stock, but it's not worth $10 billion today. So from the IPO, the partial IPO, Genworth Financial is going to raise $500 million US, $500 million. This is not going on the balance sheet of Enact, but on the balance sheet of Genworth Financial. This is money for them, for the parent company. They can use that money to repay more debt, which they have been doing. And they can eventually pay dividends and buy back shares. This is the plan of the management. Before they were limited, they could not do that. People have been asking me why Genworth Financial did not pay dividends before. It's because there have been a ongoing deal between Genworth Financial and China Oceanwide for nearly 5 years. So during this deal, before the deal happened, Genworth Financial was still in a bad situation because of the 2008 financial crisis. Genworth Financial found itself in a bad situation. That's why you will see that the stock is down. In the 2008 financial crisis, they had very bad loans on their balance sheet. So that's why things were bad for them. But things are improving now. They still have some bad loans. They are not as good as Ascent Group, but things are improving. So let's say around 2015, things were bad for Genworth Financial. Then they had this merger proposal from China Oceanwide that China Oceanwide will buy the company for $5.43 per share. They cannot pay dividends. Even though now they are doing better, they cannot pay dividends, they cannot buy back shares because China Oceanwide has a deal with them. China Oceanwide won't be happy if they are paying dividends, if they are buying back shares, because they want to buy the company at the price at which they made the deal. But unfortunately, or I will rather say fortunately, the deal did not happen. China Oceanwide could not raise enough capital to buy Genworth Financial, and also there was the trade war and other things. Now Genworth Financial has more options in front of them. They can buy back shares, pay dividends, have an IPO, whatever they want to do, they are going to do it now. They are not limited to what the acquirer wants them to do. There is no acquirer anymore. Genworth Financial, however, is more than just a mortgage insurance business. We already talked about that. That they have 3 business segments. They sold one. They are going to have an IPO with the second one. What about the third one? Life insurance. This is the main business of Genworth Financial. Even though most of the profits come from mortgage insurance, most of the revenues come from the life insurance business. And if we look at the life insurance business of Genworth Financial compared to competitors such as Prudential, such as MetLife, you will see that it is undervalued. Look at the price to tangible book value ratio of these 2 companies compared to Genworth Financial. You will see that it is undervalued. So we have the life insurance business undervalued, the mortgage insurance business undervalued. Together, of course, they are undervalued. And they are massively undervalued. So let's say we have this IPO. The IPO is a success and the stock price of Enact goes up. Why it's going to be success, why it will go up? There are so many tailwinds on this industry and all the other stocks are doing well. I don't see any reason why this one won't do well. Maybe it can happen. We don't know. This is the stock market, but I believe the IPO is going to be a success. So the stock price goes up. This will be reflected on the balance sheet of Genworth Financial, and consequently, Genworth Financial stock price too will go up. But Genworth Financial also has to be valued as a life insurance business. But when we look at the life insurance business today, it is undervalued, like I told you. I will just give you some numbers. They are going to have this IPO, which will give Enact a valuation of $4.85 billion. So Genworth Financial will own about 80%, which means $4 billion. The market cap of Genworth Financial today is $2 billion. So you see the problem here? It doesn't make sense. You have a company, $2 billion, they are going to have an IPO for $4 billion. So they are having a spin-off for a company which is bigger than they are today. In other words, it means that the life insurance business is worth minus $2 million. It doesn't make sense. This is a deep value stock. The company has an investment portfolio of over $75 billion. Book value, tangible book value of over $14 billion. A market cap of only $2 billion. Yes, it's true. There are many problems with the company. They had problems in the past, but things are improving. It's better you invest in a company where things were bad in the past but are improving than you invest in a company which is perfect. If you invest in a company which is perfect, the growth will be limited. But if you want to take the risk, of course, I'm not telling you to do that. It depends on how much risk you want to take. You invest in a company that is doing so great, but you know that there are many tailwinds on it, that it will be doing better in the future. Things are improving very rapidly. Then this is a good investment. Of course, if you want to invest in a more stable, better company, for example, let's say insurance business, you want to invest in Berkshire Hathaway. This is a stable, not volatile, very low risk company. Please go ahead and invest in Berkshire Hathaway. But I'm willing to take this risk, and I'm not going to put 100% of my portfolio in Genworth Financial. It's about 5%. This is a risk I'm willing to take. Even in the worst case scenario, it goes to zero, I lose 5%. But in the best case scenario, this is a potential Tenbagger. Because today the company has a valuation of $2 billion. In 10 years, can it has a valuation of $20 billion? It is possible. It is possible, $20 billion. Because you look at the graph of Enact, the graph of the life insurance business, $20 billion. Today, the tangible book value is $14 billion. Let's say in 10 years, it remains at $14 billion. Even then, $20 billion, $14 billion in tangible book value, this is still a good deal. So it is possible that this company is a Tenbagger. Plus, they are going to pay dividends and they are going to buy back shares. So there are many tailwinds on the company, the 2 companies, Enact, Genworth Financial, life insurance business, and the stock itself. But always be careful. Don't tell me after 2 months that Genworth Financial is down 20%, that I said it was going to be Tenbagger, what's happening? You need to think about the long term. This is how you make money in the stock market, by thinking about the long term. In the short term, anything can happen. The market is volatile all the time. It's going to fluctuate all the time. So focus on the long term. So let me know in the comments what do you think about Genworth Financial. Thank you for watching this video. Please like, subscribe and share. Please watch these two videos here if you have missed them. Have a nice day and goodbye.